Imagine you're at a fair. Everyone has a few coins to spend. Now, suddenly, the organizers drop a giant bag of free coins from the sky. People rush to buy food, toys, and rides, but there aren't enough for everyone. Prices shoot up. That's what we call inflation, when too much money chases too few goods. Meet the Reserve Bank of India, the country's money manager and economic doctor. Its main job? To keep our fairground running smoothly. Not too hot, inflation, and not too cold, recession. Just the right temperature. That's called price stability. The RBI controls the flow of money using a big lever called the repo rate, the interest rate at which it lends money to banks. If prices are rising too fast, RBI raises this rate. Borrowing becomes expensive, banks lend less, people buy less, demand cools, prices drop. If the economy is too slow, RBI lowers the repo rate. Loans become cheaper, people buy more, businesses grow, economy speeds up again. Think of it like the accelerator and brake of a car. The RBI keeps switching between them to stay on the right track. But that's not the only trick. RBI also tells banks to keep some money aside. These are called reserves. CRR, or cash reserve ratio, is the slice of money banks must park with RBI. If RBI raises CRR, there is less money to lend and inflation falls. SLR, or statutory liquidity ratio, is money banks keep in bonds or gold. Adjusting this also changes how much banks can lend. These help RBI fine-tune money flow, like adjusting the water pressure in pipes. Next, RBI performs what sounds like wizardry: open market operations. It buys or sells government bonds to control how much money floats in the system. When RBI sells bonds, it takes money out of circulation. When it buys bonds, it pumps money in. Think of it as the RBI deciding how much fuel to keep in the economic engine. Sometimes, just words can move markets. When the RBI announces its future plans, say, hinting that rates might rise, investors, banks, and businesses adjust their actions in advance. This gentle steering is called monetary guidance. So even before the RBI touches the lever, people start acting more cautiously, helping control inflation early. Here's the tricky part: controlling inflation without hurting growth. If RBI hits the brakes too hard, borrowing stops and jobs fall. If it accelerates too much, prices spiral. That's why every RBI meeting feels like a tightrope walk, keeping balance between growth. After the pandemic, supply problems made prices shoot up. Fuel, food, everything. RBI raised the repo rate several times to slow things down. Gradually, inflation came under control while the economy kept growing. That's the RBI's balancing,